Assalamu alaikum friends, welcome to Test Your Understanding 5 from your SBR Kaplan textbook. This is the last chapter in your Kaplan textbook known as question and answer, and from there this is Test Your Understanding 5. And first of all, I want to apologize to everyone for being a delay from Test Your Understanding 4 to Test Your Understanding 5. There has been some delay in between. I wasn't able to upload any videos on my YouTube channel. The reason is I was sick, I was having a bad throat, I was having cold, fever, and now I'm feeling better. So I was, my voice was fully gone. So even if I wanted, also I couldn't upload any video. Okay, because I couldn't speak. So that's the reason I couldn't upload any more videos after that day. So now I'll be uploading videos every day. At least two questions from revision kit I'll be uploading, and this I will be finishing by tomorrow, right? This test understanding 5, 4 more are there. After that we are over with the textbook questions, and we'll be only focusing on the revision kit questions for SBR for your December 2021 exam. So let's start. And I want to apologize those students also who wants me to do other papers like AAA, SBL, APM. APM is not my paper. Right? I didn't take APM, and I also didn't take AAA, but I'm trying to, I'm studying AAA now so that I could deliver, you know, AAA maybe in the next session, maybe in March 2022. That's my plan. I'm planning to do, but let's see how it goes, how my preparation goes. But I haven't taken AAA and APM as my optional paper. So that's the reason I'm not starting AAA now. The optional paper which I've taken are ATX, Advanced Taxation, and AFM. Okay, so I will not be able to do any more paper this session for December 2021 session, as my sole focus is on SBR only. But definitely, since I've uploaded videos on AFM, if you ask me doubts on AFM, that I can solve, right? But any additional videos to make on any other subject apart from SBR, I will not be able to do it now because of the limitation of time. I don't have time, as you know, and also have to prepare also. I just cannot, upload videos, just like that. I need to first go through the material, revise myself, and then I need to upload so that I can save your time. Okay, so that's the reason. But definitely for next session, I have not planned any paper. So you have to let me know which paper you want me to do for March 2022, which I will start after the December session, December paper gets over. Okay, so let's start with test understanding 5 before I, get lost off the track. So this question focuses on many standard, from standard which is not so frequent to the standard which is very frequent. Standards like IS 41, which is agricultural. Maybe most of you are not, you don't study thoroughly this standard because you don't expect this. And we have IFRS 16, then we have IS 37, IS 16. Okay, so these are the other standards. Okay, before I go to this question, you always need to look at the requirements. As you can see, from here, from test understanding 5 onwards, we have marks now. They are giving marks. So now slowly you're coming into the exam style questions. Okay, now you know the question, now you know how much you have to write. Even in your exam also you can expect this much, right? They will ask a question for 12 marks and all. Then part B we have for 6 marks each. One is for different standard. C we have for 7 marks. And always start with the requirement. Why? Because if you read the requirement, you will have a clear understanding when you're reading the case study. Okay, am I clear? So this is for total 25 marks, means it will come in your section B. Section B question looks like this, because section A is for 30 marks first question, second question is the ethical question is 20 marks. Section B, there are two questions, question 3 and 4, both are 25 marks each. So that's why I know this is section B question. Now discuss the accounting treatment. That means accounting treatment of the above transactions. All the transactions you have to discuss the accounting treatment according to the specific standard that they fall into. Okay, for the year ended, always look at the year ended. It's very important because sometimes they might give you for multiple years. Okay, so that's why for everything year ended 30th September 2004. Mark is there, three events are there. Okay, so separately you can deal with it. A, B, or C. So since A is the biggest mark, okay, a wise candidate will attempt part A first. Why? Because biggest number of marks is there. But it does not mean that if you do start with less number of marks, you will not score well. No, it does not mean. Okay. But what I was following throughout all this year, when I used to sit for a paper, see, anyway, we don't have any option, right? That option is removed now. So what I do, I always start with the order, right? Because otherwise you have to read everything, then you select which one is easy for you. It wastes a lot of time. So what I do, I just follow the order and I go by that order. Because anyway, I have to do this 12 marks question, whether first or last, I have to do it. So I start reading and I do it in the order given. Now, before that also, read this background, very important. You have to start with that and then you have to go with A, B and C, whatever you're doing. Okay. So Sunny Day is an entity that breeds and matures beef cattle for sale. Okay, beef cattle. You can understand that the nature is agriculture, right? It prepares its financial statements in accordance with IFRS as a year end of 30th September 2004. Data is held with a number of unreserved accounting issues that are detailed below. Okay. See, IAS 41, don't panic when this comes in your exam because this standard is very small and very easy to understand. Okay, it might look difficult because of cattle and how to value the fair value. It looks difficult from outside, but inside is very easy because the content is very small. Okay, and agricultural products you measure at fair value less cost to sell. That's it. Okay. So in the financial statements for the year ended 30th September 2003, you are asked for which year. Year end is 30th September 2004. But you, okay, now they are giving you the opening balance. You need the opening balance. Okay. Without that, you cannot do. So opening balance, they have reported biological asset of 1.8 million. Okay. What is this biological asset? This is why you have to go through your IS 41 and study it. Okay, if you're not familiar with what is biological assets are all living type of assets. All your plants that grow, the animals, it could be cattle that you have in your farm, sheep, lambs. Okay, these are known as biological asset. So cattle and all this biological asset has to be living. Okay, they grow and they are living. Okay, not non-living assets are not biological assets. They fall into different type of assets. Okay, see assets, when the word asset comes, you need to classify what type of asset is it. There are different types of assets: non-current asset, intangible assets, financial asset, biological. See, financial asset IFRS 9, intangible asset IS 38, tangible asset, non-current asset IS 16, biological asset IS 41. So each asset has different standard. That's why you need to know which type of asset. So clearly they have mentioned as biological asset. Okay. See, they will not mention the standard. You have to identify which standard. Just IS 41 because no other standard talks about biological asset. So cattle with a carrying amount. What is the carrying amount? 0.1 million. Died during the year end. Died. That means no more asset is not there now. And they have sold the cattle with a carrying amount of 0.4 million. Okay. During the current year, the company purchased new cattle. During the year, the company purchased new cattle. So it can be, they can purchase new cattle, right? You can sell cattle, you can purchase, they might die. So many things can happen. Okay, so they purchased new cattle and this they have correctly recognized it at a value of 0.8 million. This was partly funded by an unconditional grant. So now you see another thing is coming up. Unconditional grant was 0.2 million from a local government agency. After 0.8, 0.2, they have purchased it using the grant which they have received from the government. By the way, if I ask you this question, under which standard grant from government is dealt with? Which standard? IS 20. IS 20. So inside a big standard, there will be small standards like this. Even the main theme is IS 41. Inside that also you can expect like small standards like this. Okay. Sunny Days does not have information available to identify the principal market for its cattle. Why do you need information about principal market? Fair value. Exactly, fair value. You have to identify the fair value. How do you identify fair value of cattle? There are two types of market. One is principal market, one is advantageous market. So if principal market is not available, you Look at the information from the advantageous market, the most advantageous market, right? That's why. Principal market is not there, so now you information at least about most advantages will be given to you. Okay. So detail of the prices that they could obtain from its entire herd at the two markets available, they are given. Now you have to identify which one out of these two are the most advantageous market. Is it market 1 or is it market 2? Let's see. The estimated selling price is higher for market 2. Cost of transporting is also higher for market 2. Cost to sell as a percentage of selling price is same for both. Okay. There's a way to find the most advantageous market. We'll do later when we actually start answering it. We'll read the last para also before we attempt this. So the farmland used by Sunny Days to rear his cattle land was purchased for. What is the farmland? Okay. So apart from cattle, you have purchased farmland because where are you going to raise this cattle? In a farmland, no, you need a land also. So this farmland was purchased for 3 million. On which date? 1st of October 2002. But was revalued. Land can be revalued, right? It was revalued to 3.2 on 30th September 2003. That is the opening date. Not the closing. Closing is 30th September 2004. Due to the declining property prices in the area, land was deemed to have a fair value of 2.7. Because prices are declining overall, so price fell down from 3.2 to 2.7 at 30th September 2004. You have many things to deal in this question if you see. Cattle. To find the value of the cattle, you have to look at the most advantageous market to find the fair value. And then this farmland. Okay, and that grant also that received from the government. Okay. So you have to break down this big piece of information into small pieces and then do this question. Otherwise, you will not be able to do it. So let's see the answer. I'm not going to read the other parts because those we can read later. It's not relevant for our party. They are separate, okay? Because it's 12 marks, okay? Don't ask me how many lines, how many points. You can expect like this much of length will be there for a 12 marks question. Okay, some calculations will be there, okay? If you see, you have to write a lot. And in between, there are calculations also. So, first start with biological asset. Go in the order which you are presented. The information was presented to you. The case study starts with biological asset. So you start writing with biological asset so that you don't miss out anything. Don't start writing the fair value of the land. Okay, start with biological asset. So immediately refer the standard that you have to talk about. It is IS 41, agriculture. According to this, how are you going to do the garment grant? First deal with the garment grant. Finish it off. It's very easy. Because it's a small thing, no? So state that unconditional garment grant that are related to the biological assets will be recognized in which place? Profit and loss. When they become receivable. Okay? When you're going to receive this grant, when it's receivable, that you are going to receive this grant from the government, you recognize it in profit and loss. Okay? And what is the amount of the grant? It is 0.2 million. So this 0.2 million will be immediately recognized in profit and loss because it was unconditional. It is not based on some condition that if this happens, this will happen. So you don't have to wait for the condition to be fulfilled. You can immediately recognize this 0.2 million in the profit and loss account, the government grant that you're going to receive. Correct? Now at the reporting date. At the reporting date means 30th September 2004. Okay? You can write 30th September 2004 at the reporting date. It's the same thing. Okay? How are you going to remeasure the biological asset? That means year end, you have to remeasure, not measure. You have already measured it initially. Year end, again you have to measure. So it is known as remeasure. Okay, so biological assets are remeasured to fair value less cost to sell. Whatever biological asset, it will always be remeasured to fair value less cost to sell. So there is nothing hard. Okay, it's very easy for you to understand this, right? So fair value less cost to sell. What about the gain and losses? See, fair value, when you're writing fair value, it will keep, fair value might go up, fair value might go down. So with the gain or losses, report it in profit and loss. If you write this part also, the gain and loss part, you are completing the sentence. You are writing everything. You're not missing out anything. Some of you might just write remeasure to fair value less cost to sell. That's it. But what about gain and losses? It's not only for this. It's about any standard you take. Wherever fair value is mentioned, don't forget to mention the gain and losses also, because fair value in any standard can go up. It's a gain, can go down, it's a loss. So gain or losses reported in profit and loss, because in some standard gain or losses are recognized in other comprehensive income also. But in here, it's very easy. IS 41, profit and loss. Okay. And how are you going to measure this fair value, you have to write. So here you are writing, at the end only you are doing the calculation. Okay, you have to find the gain or loss. You have to find whether it's a gain or loss. Okay, you have to do this gain on revaluation, because your biological asset has been revalued. You have to find the gain. Okay, so workings and all you anyway have to do, but here you are explaining what you are doing basically, because accounting treatments you have to explain. Accounting treatment means you have to explain. Wherever calculation is required, do calculation also to support your answer. Okay, accounting treatment does not mean okay always calculation. I will just write it's debited here, it's credited here, that's it. No, you have to write also. Okay, so now comes the fair value. You wrote fair value less cost to sell, gain and loss will go profit. And now talk about the fair value. Fair value is your theme now. Start from here. The whole para in fact is about fair value. If you see till here it's about fair value only. So now start with the definition of fair value. What is fair value? Whenever fair value is given under any standard, it does not matter which standard you're talking about. Fair value is there, start with the definition. And this definition you can memorize it. Right? It's used everywhere. If you have another way of better defining fair value, that also you can do. Okay. But the safe side is use their definition given to you in your textbook. Define as the price that would be received from selling an asset in an orderly transaction amongst market participants. The measurement. That means at that date, when you're measuring their fair value, at that date, what is the price that you are going to receive when you sell this similar asset in the market? That price is known as fair value. The market, the price that you're going to get from the market on that asset, the asset that you're having, selling, that is known as fair value. So in that way also you can write, or this definition also is you can write. Now, after the definition stops here by the way. After the definition, what are you going to write? You have to write that fair value is determined using two markets. Principal market. If the principal, in the absence of the principal market, if principal market is not there, then the most advantageous market, but you have to mention this in your answers needed. Okay. And what is this most advantageous market? Please define. Most advantageous market is the market which maximizes the net selling price that an entity will receive. That means that whatever the out of the two markets, you have been given market A and market B. Out of this two, whichever under whichever you are getting the maximum net selling price, that is your most advantageous market. See, most advantageous means most benefit, right? So net selling price has to be the maximum, more. So in out of this two, whichever is more is your most advantageous market. Calculation is there. You have to find out this net selling price. It will not be given to you like this. Okay. So don't expect everything will be given to you as it is and you just have to know. You have to find out. Okay, so now you are referring this here to the case study. Bring this to the case study, to the biological asset. So principal market cannot be determined in this case. So fair value of the biological asset at the year end must be determined with reference to the most advantageous market. Correct? Now we are finding the net price that is received in market 1. And where is this one? Where is market? And this is for market 2. So when calculation like this, you can show there itself. You don't have to show it in a separate place, but if you want to show it in a separate place, you can show it in a separate place known as refer to working 1 or 2, and later you can show somewhere down. Okay, that's up to you. So if you see out of the two, which one is giving you the higher? Market 1 is giving you the higher, 2.49 versus 2.39, right? The net price. So market 1 is your most advantageous market, and this should be used to determine your fair value. Write that also. Now we'll go to the calculation of the net price for market 1 and market 2. Okay, if you understand market 1, you will understand market 2 also. It's the same way. Okay, so how do you do that? It is, let's start with market 1 first. So it is your estimated selling price minus your cost of transport, 2.6 minus 0.1. From that you deduct cost to sell. This also you deduct. Cost to sell is given in terms of percentage. How can you minus it in terms of percentage? It's given here as a percentage of selling price. That means cost to sell is 0.5% of the selling price. What is the selling price? 2.6. So 0.5% of 2.6. This amount you have to minus from 2.6 minus 0.1. First you deduct transport cost from estimated selling price, then you deduct the cost to sell. Cost to sell you have to find like this, 0.5% of the selling price, and deduct it and get it. Same way you have to do for the market 2 also. I'm not going to show you, it's here already, you can see. 2.6 minus the transport cost, and this is how you find the cost to sell, right? Because it's given in terms of percentage, and find the amount. Now we are going to the last para. You see, every item they are using subheading. Here they are using biological asset. They talked about grant and then they talked about the fair value. Two things. Now we are moving to the land. Before land, let's finish this last para. Land is the second item, okay? And then the working. And that's it. We'll be moving to part B after that. You have to find the fair value of the herd also. Because once you identify that you are going to use market one to value your fair value, now what? Find the fair value of the herd. Find the fair value. How are you going to find the fair value? Okay. How are you going to find the fair value? It is the selling price. We are referring to market 1, okay? Selling price 2.6 minus your cost to transport 0.1. See here, in case you forget every time. Don't take this cost to sell now. So it's 2.6 minus 0.1, which is 2.5, right? Right? It's 2.5. So here it will be 2.5. This is the fair value of the herd. But how are you going to measure the biological asset? Herd is a biological asset. Fair value less cost to sell. Okay. So it will be 2.49 here, because this is fair value less cost to sell only, 2.49. So it will be 2.49. See, fair value when you are taking, don't deduct cost to sell, only transport cost from the selling price. But you measure biological asset fair value less cost to sell. So cost to sell also you deduct, which already you have calculated here. If you see 2.49, okay. So this 2.49 only should be recognized as the fair value of the herd. So herd should be recognized at this amount, at the reporting date. Or you can mention the date 30th September 2004. Herd should be recognized at this amount. And remember, whenever fair value, gain or loss will be there. In this case, it's a gain. And working also, you have to write like this. So this is the gain. And this will be recorded in profit and loss, as you have told earlier. That gain or loss will go here. Okay? This is how much you have to recognize the gain. Let us go to the gain here. Working. Working one always at the end, after you finish everything. So they have already told you how much you are going to brought forward. Brought forward is 1.8. You have purchased 0.8. Does not matter how much of the grant or whatever it is. Full purchase price you have to write here 0.8. And death or disposal was 0.5. Then the gain. This is a balancing figure. Okay. Because the carrying forward 2.49 you have already calculated here. 2.49, right? Fair value less cost to sell only. This is your fair value less cost to sell. That is your carry. So gain, this is a balancing figure. $0.39. Let's see here again with the figure, in case you forgot. So what is your opening balance here? Okay, I will highlight it for you maybe. Opening 1.8. Correct? You have purchased 0.8. Correct? And how much of they've died and this thing? 0.1 died, 0.4 you sold. So that means total 0.5. Both the death and disposal. You have to deduct the 0.5. The one who died also, the one you disposed also. You see here? That's why you are deducting 0.5, 0.1 plus 0.4. And closing you already have. So balance is the gain. Because at the end, your value went down. Went up. Balance went up of the biological. That's why it's a gain. Okay. Now we are moving towards land. This is easier than that one. Okay. This you have to use the rule of IS 16. Please understand. Now the rule changes. Okay. So the land, remember, you might be wondering it's related. It's a farmland. Okay. Understood, it's a farmland. But still it's a land. Whether you're using it for the purposes of farm or something, it's a different thing. Okay. It does not matter. Still the land, when you're using it, you have to use the rule of IS 16. The herd and everything what is there on that land, that you are valuing using IS 41. That we have already done, herd and everything. But that farmland, you are going to put it under IS 16. So, okay, and this land is an item of property, plant and equipment. And for property, plant and equipment, IS 16. Okay, So any revaluation of this item, there has been a revaluation, right? But value went down. This will be recorded where? It will be recorded in profit and loss. But if a revaluation surplus exists for that specific asset, unless a revaluation surplus exists, if there's a revaluation surplus, then you do not recognize it in profit and loss. Then it goes under the revaluation surplus only. For that specific asset, for that farmland only, let's say there's a revaluation surplus from before. Now there's a loss, so that loss that will go to the that revaluation surplus, and it will reduce that revaluation surplus amount. Understood? But if there is no revaluation surplus from before, then it will be recorded in profit and loss, because this is regarding revaluation losses. Okay, don't panic why it's not in other comprehensive. It is revaluation gain that goes under other comprehensive income according to IAS 16. Revaluation losses goes in profit and loss only. This you need to identify. This you need to know. If you forgot the rule, please revisit my video on IAS 16. It's there. Okay. So if you see the revaluation from 30th September 2003, from 3.2 it fell down to 3. It's 0.2. Okay. This will be recorded in, sorry, it increased from by 3 to 3.2. So that 0.2 gain will be recorded in other comprehensive income. That means it will be held within a revaluation surplus reserve in equity. And the downward revaluation, okay, that means it's a loss, which is 0.5, will be, how are you going to charge this? How 0.5? Because from 3.2 it fell down to 2.7. Earlier you have a gain of 0.2 already under other comprehensive income. See, when there's a gain already existing and you have a loss higher than that gain, there's a rule. You cannot recognize 0.2 in other comprehensive income and 0.5 under profit and loss, like just like this. You have to adjust. You have to bring down that gain in the revaluation surplus to 0 first, and then the remaining loss recognize in profit and loss. Understood? So out of this 0.2 other comprehensive income, you have a loss now. This is a gain, okay? You have a loss 0.5. Out of the 0.5, first deduct 0.2 from other comprehensive income. Out of 0.5, 0.2 went. What is remaining is 0.3. This 0.3 only you will recognize in profit and loss. Understood? The loss. That's what it is explained here. So this 0.2, exactly the same amount, will go under the comprehensive income, and remaining 0.3 will be charged to profit and loss. This is the rule if revaluation surplus occurred first and then a revaluation loss occurred, and that revaluation loss is higher than the amount of the revaluation surplus. Okay, let's see the amount before we go to part B, because I clearly want you to understand this part is very important. This type of question comes very regularly and most of the students struggle here only, when it first goes up and then it falls down. Just see here. Okay, earlier it was, okay, maybe I will highlight it for you. It was 3, and from 3 it increased to 3.2, right? And then from 3.2 it fell down to 2.7. First there is an increase, then there's a decrease. You have to know how to write this. Okay, so this is a very good question for that. You might revisit here and come back, or you might do similar questions like this in your revision kit also. Maybe I've done also, I don't remember, but some questions maybe I've done it, so that you can do. Now we are moving towards part B. Part B, as I can see from the answer, it is about IS 37, even though I haven't read it. Okay, but let's see. And it's for less marks, 6 marks. So 1st of Jan, the government announced new legislation which made some of the farming methods illegal. It's about new legislation. This laws became effective on 1st of September 2004. Remember, your end is 30th September 2004. Just 1 month before only this became effective. That means at the end it will be effective, right? So due to the short term cash flow difficulties, Sunny has not yet started to comply with the new legislation. It is estimated that the cost of compliance will be approximately 0.8. Government has said that fines for non-compliance are 0.1 million per month and it will be strictly enforced. The directors wish to know how to account for the above cost as well as any resulting deferred tax impact. Fines are not a tax allowable expense, and they pay a tax at a rate of 20%. How do you know whether it's a provision or what? So first of all, look at the time period. And it's something to do with future, right? In the future, you have to comply. If you don't comply, the fine is this much. Whether you have an obligation to report this cost or not. This nature will tell you whether it's a provision or not. So from this nature, you know, this will fall under IS 37 provision. You have to deal with this under provision. Okay, whenever it is something to do with the some legislation that government has introduced, you are not following, right? Some new law came, it has more to do with provisions, right? And the and deferred tax also. So let's see for part B. So immediately you have to talk about a provision. So you have to write in your answer basically what they are trying to ask you indirectly is whether you have to recognize a provision or not. How are you going to account with this cost means how are you whether you have to recognize a provision or not. That's what the question is indirectly asking you. See. So whether you have to recognize a provision or not, list out the rules from IS 37. Here you are not referring to the case study anything. Just as it is your knowledge part. Whatever you have studied about provision, what are the three conditions that needs to be satisfied, you are writing it down. Okay. So these are the three conditions like this. First, second and third. Present obligation has to be there from some past event. There's a probability that there will be an outflow, that means you have to pay in cash maybe, and cost can be estimated reliably. So present obligation, outflow, and estimated reliability. These three conditions are there. Provision has to be recognized. So according to this case, let's see. No provision should be recognized for the 0.8 million cost of compliance. What is the cost of compliance? 0.8 million. For this, no provision should be recognized. Why? If these three conditions are not met, no provision. So maybe out of these three conditions, they have not met. One or two conditions, or all the three conditions were not met. Maybe, let's see. There is no obligation to pay. Start one by one. This is number one, this is number two, this is number three. So let's see whether the first one is fulfilled or not. First one is not fulfilled. Cross mark. You don't put cross mark. I'm just putting it to show you that it's not satisfied. There is no obligation to pay. Why? Sunny days could simply change the nature of his business activity. Why? They do not have an obligation. See, obligation means you can, whatever you do, you cannot avoid it from happening. You have to carry it. For example, interest on loan. Can you avoid? Can you say I will change my business, or I will now go to, like, I will close down my business, I will go to some other country, I don't have to pay this loan? No, no, you cannot say like that. You have to pay the loan, the interest on that loan, the amount of the loan, no matter what. You cannot uh, avoid it at any condition. You have to pay. There's an obligation. But in this condition, there is not such an obligation. Why? Because they can simply change the nature of his business. Maybe from the farming activity, they might go to some other activity. So if they go to some other, see, this law is for farming activity. They think that it's illegal. If they go to some other business activity, then this law is not applicable for them. So they don't have an obligation. You can avoid this cost by changing your business activity. So when you avoid something, it's not known as an obligation. You don't have an obligation. So first condition not met. If one of the condition is not met, it's not a provision. Does not matter whether you have to meet all the three, then only a provision. If not one, no provision. Okay. Now, what about that fine? They told that they are going to charge some fine of 0.1 million. So when provision is spoke about, mention about each and every cost. One is 0.8 million cost of compliance, the other one is the fine. So for both the things, you have to say whether provision has to be recognized or not. Okay. 0.8, no provision. What about 0.1 million, the fine? For this, you have provision should be made. Why? Because there's a probable outflow of resources from a past obligating event. What is that past obligating event? From the past, now there's a probability that no, you have to pay this. Why? Because in the past, if you break the law, on breaking the law, you have to pay this. You cannot avoid. If you break the law, you cannot say I broke the law and I'm not going to pay this fine. That you cannot avoid. So in that case, fine becomes a provision for you. Now you cannot say, oh, here I'm going to change the nature of the business. What about this? See, this is a different thing. In this case, you are carrying with the same business, you are breaking the law, so that fine you have to pay. Okay. Because this past obligating event for this fine is what? Breaking the law. Whatever you do, breaking the law is the past obligating event for the fine. It's not whether you stay in that business or not. Okay. But they have clearly mentioned about fine something. One thing they have mentioned, that it is not an allowable expense for tax purposes, the fine. Okay. So because this fine, you have to talk about tax now. The last para is about tax only. Because this is not an allowable expense for the tax purpose, what should you do? So the difference between accounting and tax treatment is not temporary. You cannot say it's a temporary difference and recognize that means no deferred tax balance is recognized. If there is no temporary difference, there is no question of deferred tax. You cannot have a deferred tax when there is treatment. Sorry, the difference is not temporary. Deferred tax only comes on temporary differences. If the difference is permanent, no deferred tax will come. So no deferred tax is recognized. Understood? If it's the other way around, if this was allowed, this expense was allowed for tax purposes, yes. Then from the tax treatment, they will deduct that tax, and from accounting and tax treatment, there will be difference, and that difference is temporary. Then it's the other way around. Then deferred tax will be recognized. But in this case, it's not an allowable expense. That means you cannot deduct this fine from the tax treatment. So accounting is also same tax treatment. The difference, if also they have any difference, okay, that difference is not temporary. It will be permanent only. Understood? It will be a little difficult, but unless you do more questions on this. But anyway, this is a good starting. Finally, we are moving to part C. Okay, this is about leases. 7 marks. He enters into a contract with a supplier to use a specific retail util for a period of 5 years. So the nature itself tells you that it's a lease. Okay, you're going into a contract to use something for a 5 year. Unit 5 is a part of a larger retail space owned by the supplier. It's about a retail space that you're going to use, and they will use the retail unit to sell the farm produce to the general public. Okay, during the 5 year, the supplier can force. You have to look at the terms, and so these are the terms of the contract that you are giving. Conditions you have to see. They can force them to relocate to one of the other retail units during this 5 year period. And the terms of the contract state that the supplier would have to pay all of the Sunny Days relocation cost and make a payment to compensate for the inconvenience. The supplier would only benefit from moving them if a larger retailer wished to move into 5A, Unit 5A. And if they are willing to commit to using this space for more than 5 years, this is thought to be possible but unlikely. They must open and operate Unit 5A during the hours when the large retail space is open. However, Sunny Days can sell whatever products it wishes at whatever prices it determines. The supplier will provide cleaning and security. They will provide the cleaning and the security services, the supplier. That means the lessor, right? They will make fixed quarterly payments to the supplier. That means the lease payment. Quarterly payments they will make for the Sunny Days. And they will also make an annual variable payment. So one is fixed payment, the other one is variable payment. How this variable payment is calculated as a percentage of the revenue generated by Unit 5A. The directors of Sunny requires advice on whether this contract contains a lease or not. Keep your eyes and ears open. Sometimes what looks like a lease might not be a lease. Sometimes what is not a lease is a lease. Okay, because sometimes it could be a contract with a customer. Then you have to recognize a revenue according to IFRS 15. So be very careful. These two standards are very closely connected. You might misinterpret them in a wrong way. Okay, so let's go to C. Okay, now to know whether it's a lease or not, first identify what is a contract with a lease is about. Define. A contract contains a lease if this it's already in bold. I'm not going to highlight or do anything. If it conveys a right to control the use of an identified asset for a period of time in exchange for, that means you have to pay the consideration to the lessor, and for paying that consideration, you are using that asset for some time, for some identified time. Okay, that means for that time you are using the asset. Because you are using the asset for that, in exchange you are paying them also, the lessor. That is the meaning of lease. And if this is there in the contract, then it's a lease with a contract. So to assess further whether this is the case, IFRS 16, which standard? IFRS 16 talks about leases, right? They require the entities to consider whether the customer has. So if it's a lease, you have to see these two things. This is whether the customer has these two things or not, because it says and means both the things has to be there. Number one, the right to the benefit. That means whatever the benefit from that asset is coming should go to the customer. Customer has to receive it. Second, the right to direct the identified how they are going to use the asset. That asset, the right has to be with the customer. If these two things are there, then it's a lease. So now we are going to refer this to the Unit 5A because this is the asset. You have to identify a specific asset also. So in this case, Unit 5 is the asset, right? And it was already there in the contract. They have mentioned it. So although they can be relocated to a different unit, the supply is unlikely to benefit from this. Supply is not going to benefit from this, even though they can relocate sunny days to a different unit. So in this case, who has the right? The customer. Customer is the sunny day. They have the right to use an identified asset over the contract term, that is 5 years. Okay, what about the right? Do they have the right to benefit? They have the right to use and identify. What about the benefit? They have the right to the benefit also from using using 5A unit, right? The sunny day. They have the exclusive right for 5 years. So they are going to receive this benefit for 5 years from using this asset. It will go to sunny day only directly. It will not go to anyone else. So that means they can make sales and they can generate profit also. And what about the payment, the consideration that you have to pay to the supplier? The consideration paid to the supplier based on the revenue generated. That means based on the revenue, whatever is there, a percentage of it you are going to make a payment to the supplier. So this forms a part of a consideration. When you are paying your supplier, you have to add this also into that fixed payment. Okay. Now they have the right to direct the use of unit because it decides. How do you know whether they have the right to direct the use? We talked about the benefit, right? See this 2 points. Out of this 2 point, this is over. We told okay, they are only getting the benefit. What about the second point? The right to direct the use, how you're going to use the asset, who is going to say what to do, who has this control? We have to, it's explained in this para. Okay. So who is having the customer? Sunny Day is the customer. They have the right to direct the use. How can you say this from the case study? Because they decide what products they are going to sell. They decide at what price it will be. Correct? Their supply is not telling anything. They only provide maintenance, cleanliness, and security only. So the restrictions on an opening time outlined in the contract define the scope. You might say, okay, there are some restrictions that when they are going to open. But this restrictions that has opened in the outline, this just defines the scope. Within this opening time, still they only will decide at what product it will be sold and at what price. It is their right of use rather than preventing Sunny Days from directing use. It's not preventing the Sunny Day from telling that they cannot have a say. We are going to say how you're going to use the asset. No. They are leaving it to the Sunny Day. They will decide how they are going to charge the price, what product they are going to sell. It's up to Sunny Day only. Okay. And the supplier, they are providing security and maintenance. This has no impact on the how this one is used. How are you going to use your asset? It will not be impacted by your security and maintenance that you're going to receive from the supplier. No. Okay. So based on the above, what do you feel like? This contract between Sunny Day and its supplier does contain lease because it satisfies these two conditions. Number one and number two. Understood? They are having all the right, customer is receiving all the benefit, and they only have the right to say how they are going to use the asset, the unit 5A. So because these two conditions are satisfied, it's a lease. So that's it for test understanding 5, and see you in test understanding 6, the next question. So till then, take care.